Hey, this is my friend John, and he's just setting up his new bookstore. And that's my neighbor, Peter. Peter is also setting up a grocery store business this month. John began his bookstore business with $10,000. During the first month, he had already rented out a place. He first found out where he could buy books at a good price. He then went ahead and purchased books worth $5,000, but he only paid $4,000 to his suppliers. The first customer that came purchased books worth $60, and he paid the full amount to him in cash. The next sale was for $150. Now this customer was John's friend, and so he promised to make the payment the next day. There were a lot of customers who came to buy books from John during this entire month. Now at the end of the month, John had to pay rent for his bookstore and pay for electricity bill. He also had to pay for printing of banners and for everyday tea and coffee expenses. Now what happened was the supplier came to take his money, and also the person who made the banners for him, and then the guy at the tea stall. Everybody was here, and John didn't have enough cash with him on hand. He had forgotten how much money to pay each one of them. He did not write it down or record any of the transactions that happened. He still had not received money from people he was supposed to, and he was helpless because he had no record of how much to pay and receive from whom. So John was in a total mess. He called me up yesterday and narrated his story to me as I'm an accountant and asked me to come down and help him with all the accounts. The first thing I asked him was, "Did you maintain any records, maybe just on a rough chit?" And he said no. So unfortunately, I had to tell him I would not be able to help him. On the other hand, I also met Peter that day, and he was quite happy with his grocery store. I asked him whether he was keeping track of his daily transactions, and he said yes. He had noted everything, but it wasn't systematic. So he asked me to manage his accounts for him in an organized form. He was quite concerned about his business. He showed me his records. These records were not helping him to know the actual progress of the business. He is unable to make decisions like what is the profit of his business, were his expenses too much compared to his income, and so on. This is where we need to work on the simple records and prepare some further reports that will help him to make these decisions. These were his records, and after a little classifying and analyzing, this is what I made out of it. Now from this report, you can see that he purchased grocery worth $6,000, and he paid his rent, electricity bills, and for tea and coffee expenses for a total of $1,000. So $6,000 plus $1,000, he spent $7,000, right? And what he received from selling grocery was $9,000. So he received $2,000 more than what he spent, which means there's a profit of $2,000. Now he initially invested $10,000, and we know that he made a profit of $2,000. So he should have $12,000 with him. So where is all this money? This table here shows that he has $9,000 in his bank and $3,000 with him in cash. So his balances are matching here. So by preparing these reports, we know the stand of Peter in his business. We know his profits, and we know exactly where is the money. These reports we made will help him to take important decisions in his business. So what did we learn from this story? John did not maintain any records, which is why we could not further help him to prepare any accounting reports, but Peter kept records. This initial records maintained is nothing but bookkeeping, which is the first step in making reports. And this whole procedure of keeping records, classifying, and analyzing to make reports which help in decision making is nothing but accountancy. Accountancy is essential for any business activity, like we saw in this case. But the knowledge of accountancy can also be applied in a lot of other everyday crises we might face, like where to invest your saved money, what's your household income and expenses, which car should you buy, loans, mortgages. The use can be endless. So that's all for today. Thank you. In our previous session, we saw how accountancy plays an important role in business and in decision making. But before moving on to learning the record keeping in detail, it will be easier if we understand the meaning of certain basic words or terminologies that are generally used in accountancy. In our previous session, we saw that Peter brought in $10,000 in his business. This money that is brought in by the owner into his business is known as capital. So Peter's capital is $10,000. And the person who brings in this capital, and in this case being the sole owner, is known as a proprietor. So Peter is the proprietor of his grocery store business. In this month of May, Peter went to a furniture mart and he purchased a chair and a table for his store for $2,500. The chair and table will help him in smooth functioning of his business. Such things are known as assets. Since this is an asset which will be used for long term in the business and is not meant for sale, it is called a fixed asset. Now, can you tell me what Peter's business involves? It involves buying and selling of groceries as the main activity, right? So this grocery will be called his goods. Goods are always purchased for resale. But goods can be different for different businesses. For Peter, furniture is an asset and grocery is his goods. But what if someone had a business in furniture? What will be his goods? In that case, furniture would be his goods. In the same way, for a person who owns a bookstore, goods will be books. When goods are bought, they are called purchases. And when goods are sold, they are called sales. Are we good so far? Let's move further. Peter went to a supplier and purchased goods worth $4,000. He paid the supplier $3,000 cash, and the remaining $1,000 he promised to pay within 45 days' time. The goods that were purchased in cash, where payment was immediate, are called cash purchases, whereas he took 45 days' time to pay the remaining money. This is a credit purchase. This means that payment will be made at a future date. What do you understand from the word credit? It relates to some sort of a benefit, right? So the person who gives this benefit or allows a credit is called a creditor. Peter's supplier is a creditor. But Peter has received this benefit of time. This means he has to pay at a future date, which means he is in debt. He owes money to the supplier. Therefore, Peter is the debtor here because he is in debt. Peter then started selling grocery. Most customers paid him in cash. For Peter, these will be cash sales. A customer purchased goods and promised to pay in 1 month's time. These sales are his credit sales. Here the situation is reversed. So can you tell me who is giving the credit and who is in debt now? Here Peter is giving the credit, so he is the creditor. And his customers are in debt, so they are the debtors. Okay, let's move further. Now, Peter had to pay his monthly rent and electricity bill for $500. These are recurring in nature, or you can say they are to be paid on a day-to-day or monthly basis. Such payments are known as expenses. Can you recollect what are assets, goods, and expense? Can you tell me the similarity or the difference between the three? In all the three cases, money is going out, but it's going out for three different purposes. Can you tell me what is the purpose? Assets, for functioning, not meant for sale. Goods, for resale. Expenses, for day-to-day or monthly activities. Now, can you tell me the difference between a creditor and a debtor? The person who gives credit or benefit of time is a creditor, whereas the person who receives this credit of time and is in debt to pay on a future date is a debtor. All of this, purchasing, selling, paying expenses, anything where goods or services are exchanged for money or money's worth are called as transactions in accounting. When we maintain records, these different transactions are recorded under different heads, known as accounts or accounts head. For example, all cash transactions will be noted under a cash heading, called as a cash account. And all credit purchases with the suppliers will go under the creditor account. Let's go back and see all the different terms that we covered in this session. Thanks for watching. In our first session, we've seen the importance of record keeping and accountancy. My friend Peter is now aware of different terminologies that are used in accounting, which we have studied about in our second session. This is the third month of his business, and his grocery store business is now really going big. So Peter also needs to learn accounting in more detail to manage his business in a proper manner. So in this session, we are going to try to learn the basic accounting concepts or principles which help us to prepare our accounts in a more systematic manner. Now, accounting reports are kept by accountants all over the world for different businesses. There are many parties that need to know about your business or your company, like investors or creditors or shareholders, individuals who want to invest, banks who provide loans to them, government agencies who collect taxes, etc. This means accounting record of your business is just not meant for you. There are many more stakeholders or outside parties who need to read and understand your accounting records. Now suppose this person represents the outside parties. And if all the companies or businesses kept records differently, that means in different manners and different style, it would be very difficult for this person or other parties to understand these accounting reports. So, it would be much more easier if there were certain basic guidelines and rules as to how everyone should maintain their accounting reports, right? Now, so that there is uniformity in maintaining these records, there are certain concepts and guidelines that are known as Generally Accepted Accounting Principles or GAAP, which is universally accepted. Now, we will learn about these basic accounting principles as we come across what is happening in my friend Peter's business in this third month of operation. This month, Peter tried to maintain his own records, but when I checked it, I felt there was something wrong. Let's look at his report. He's recorded his rent, his salaries, his electricity. He's recorded his residence maintenance bill, and he's also recorded a washing machine purchase. Oh, residence maintenance bill? Is this supposed to be considered as a business expense? And this washing machine is for personal use, but he has recorded it as his assets in his business accounts. Well, these accounting treatments are wrong. It is not possible to find the correct state of affairs of his business if he mixed his personal expenses into his business. So all of his personal expenses or assets purchased do not form part of his business activities. Either he should have paid these expenses from his personal bank account, or he needs to show these payments as personal and account for it separately. Basically, all personal matters of the owner are totally separate from his business. This is a concept in accounting called as the entity concept, where the business is considered a separate entity from its owner. Entity means has a distinct identity. Now suppose Peter had two other businesses, say Peter's car repairs and XYZ bookstore. He would keep all of their records separate as well. Separate books of accounts for Peter's car repairs, separate books for XYZ bookstore, and separate books for his grocery store. So the entity concept states that a business is a separate entity from its owners. We see that the owners of businesses or companies change. We also see that ownership is passed on to their children or somebody else. But does the company or the business close down? No, the businesses or company still stays in its own place with their own distinct identity. In other words, death or insanity of the owner may not affect the continuation of his business. So business is independent from its owners. They are two separate entities. This was the entity concept. Let's see what happened next. Peter purchased a grocery weighing machine for $2,000, which is going to benefit his business for 10 years. So will he treat all of this $2,000 as his expense for current year? Well, any business needs to be treated as continuous because usually every business or company starts with the intention to stay in business for a very, very long period. Unless there's a specific event due to which it is mentioned that the business is going to last only for a definite period. So what is important here is this machine will be used for 10 years. And since we are going to assume that this business is going to be continued for a very long period, we do not have to record the entire amount as an expense in the current year. The entire cost for weighing machine needs to be split into 10 years. All of this $2,000 will not be treated as an expense in the year the asset was purchased. Only 1/10 part, that is the expired cost of the current year, will be treated as expense, that is $200, and the remaining $1,800 will be shown as an asset. As this weighing machine is an asset to the business, it's going to be used for a long period. Now, every year, the value of this asset will be reduced by 1/10, and then it will be shown under expenses. Here, we are believing or assuming or we are treating that our business is long-term or continuous, and that is the reason we will provide for the remaining expenses in future. So this assumption that the business is going to always be going on is known as the going concern concept. Concern here is nothing but the business. Let's take another example. Suppose Peter spends huge amounts on advertisement, say $6,000, but it will be beneficial for his business at least for 6 years. So only 1/6 of the entire amount, that is $1,000, will be shown as current year's expense, and the remaining $5,000 will be shown as assets, and it will be reduced 1/6 every year. Now, what if a business needs a long-term loan? Will the bank provide a long-term loan if it has been mentioned that the business will only last for a definite period in their records? Well, they may not provide the loan. But if a business is a going concern and has provided for payments in future and has a good reputation, only then will the bank provide a long-term loan. I hope you're getting me. So this was the going concern concept. You always assume that a business is going to be continuous or long-term. I hope you enjoyed this video. Please share it with those who can benefit from it. Thanks for watching. So this is the 4th month of operation of my friend Peter's business, that is July. In our previous session, we came across some principles in accounting like the entity concept and the going concern concept. So let us see what is going on in my friend Peter's business this month. Peter purchased goods worth $500. Now this is something he will record in his books as purchases. Then he sold some goods on credit to Ron. So he will record that Ron is his debtor and he has to receive $500 from him. But one of the days he was just thinking about how he started his business and how after a few months his business has improved, and he was feeling quite proud and happy. So, would he also record his happiness in his accounting books? No, happiness is something that cannot be valued in terms of money. So he will not record happiness. This is nothing but the money measurement concept of accounting, which states that only events that can be valued in terms of money can be recorded in accounting books. So death of a partner, happiness, sorrow, love, all these cannot be recorded in accounting books. After some time, Peter purchased an insurance policy for loss of goods from one of his friends who owns an insurance company. So he purchased this insurance for $2,000. But the actual market price to acquire this insurance policy is $3,500. So which amount will he record in his books? He can only record the price that he has paid to acquire this insurance, irrespective of what price is actually going on in the market. Peter also got some furniture from his father-in-law for $500. The actual price of this piece of furniture was $1,000. So at what price is he going to record this? He's going to record that he purchased furniture worth $500 and not $1,000. Now this month, Peter also purchased a mobile phone for $200 to take grocery orders on call. He is strictly going to use this mobile for his business use. But only in 2 days, the price of that mobile model dropped down to $120. So at what price will he record his asset purchased? He will record only that amount that he pays or is liable to pay, which is $200. So this is the cost concept, which states that transactions are recorded at cost price and not the market price. So that is all for today. We've covered the money measurement concept and the cost concept. Thanks for watching. Well, in the past few months, my friend Peter's business is going pretty well, and the records that he's keeping is helping him to keep a track of all his business activities, and due to that, he's also more confident, and it's also overall helping him to take decisions. Thus, it's helping his business to perform better. He has now learned that he must keep his business and personal expenses separate, and must always assume his business to be long-term or continuous. He also understands that he can only record the things which can be valued in terms of money and record any transaction on the actual price paid or what is liable to be paid and not on the market price. This is the 5th month of Peter's grocery business, that is August, and he has a little trouble understanding when he should write or record his transaction in accounting books, because the other day Mr. Y came to his grocery shop and said, "I need these 4 items, but I will come and buy them later." That day Peter was confused if he should record that in his accounting books. So what do you think? Can he record those 4 items as sold? Well, they haven't been sold yet. There isn't any guarantee that the customer will come to buy those goods. So when a sale is uncertain, Peter cannot record or recognize this as a sale in his accounting books. Either payment should be made or both the parties must legally agree on the transaction for it to be considered as confirmed. Now, the next day, the same customer comes and confirms this purchase. he signs a note that he is liable to pay $200 in 1 week's time, and he asks for the goods to be delivered. Here the price he agrees to pay, that is $200, was fixed on the day he confirmed his purchase. In this case, can the transaction be recorded? Yes, here both the parties have agreed, means there is certainty that goods will be delivered and that $200 will be paid in 1 week's time. So Peter can record this transaction even though the actual cash has not been received. So this concept where you recognize or record sale of goods and services when transaction is certain or complete is known as the revenue recognition concept in accounting, because it tells us when to recognize revenue. Okay, let's proceed further. Now, after a few days, Peter ordered some stationery items for $580 from an online website. He needed them for packaging of his grocery supplies. Here, the price is confirmed. He paid the order amount $580 through a debit card. The delivery of goods is promised to be made in less than 2 weeks' time. Now, in this case, stationery is an expense for Peter, but it is a revenue for the seller because he made money out of sales. So, will the seller recognize or record the sale of goods as revenue? Yes, because once payment is made, definitely a transaction is certain. So he can recognize this $580 as a sale in his accounting books. And Peter will simply record this as an expense. Now, here in all these cases, we were talking about the revenue, which means receipt from goods and services. And when exactly is this revenue supposed to be recognized or recorded or realized in accounting books? All these words mean the same thing. So when can it be recognized? 1. When transaction is certain. 2. When either payment is received or is legally agreed upon, means it is recoverable. And 3. The goods may be delivered or agreed upon to be delivered. So these are the 3 things to keep in mind for the revenue recognition concept, also known as the realization concept. Now, Peter's doubts are cleared, and I hope it clarifies some of your doubts too. Moving on from this month there was a special visitor in Peter's grocery store, the auditor. Do you know who an auditor is? He is a qualified official, and it is his duty to check on the accuracy of business records. He demanded that Peter showed all of his business records. But now, in order to verify the accuracy of Peter's records, he also needed some proper proof. Like, if we go and purchase an item from a store, we get a bill as a proof. The seller saves this copy of the bill to keep it as a proof of his sale. He uses all the proofs like receipts, invoices, payslips, bills, etc. to support his records. So these little written documents are called as vouchers in accounting. Peter too had saved all the vouchers, and he had attached them to his records as proof. As sometimes, government agencies or auditors may come to keep a check on your records. So this is nothing but the concept of objective evidence, meaning we should have concrete or physical evidence or proof of all our records, and the records should be objective. That means it should be unbiased, non-influenced by personal judgments. It should not be mere imagination. So this was all in the month of August. Thank you. So these are the different principles of accounting that we've covered so far. If you have missed any of these, do click on the link and check them out. So we've been talking about how record keeping has been helpful for my friend Peter. He has been enthusiastic in learning accounting. There have been some problems that he has faced as to when to record transactions, and slowly he's understanding and improving himself. It is now the 6th month of his grocery store business. We are in the month of September. Let me tell you what happened a few days ago. So it was the end of a long day for Peter, and before closing down the store for the day, he was counting his cash. He counted he had $300 cash. He kept it back in his drawer and locked it. The next day, he made a sale of $800 cash. He only recorded his sales transaction, which was $800, in his sales account. But he forgot to record the same in his cash account. Later that night, when he checked his cash drawer, he had $1,100 cash. But the cash account in his accounting books was still showing $300 from yesterday's sale. This means without recording both these effects or dual effects in books of accounts, our records will be incomplete or imbalanced, and it will show a wrong status. In this case, there were two accounts affected, that is, the sales account and the cash account. So basically, if any transaction takes place, it affects two different accounts. Let's try to understand this concept. Let's say Peter sold goods on credit to Mr. Adam worth $300. This transaction results in impact on two matters. Can you tell me what are the two accounts that will be affected? The sales account will be affected as goods are sold for $300, and Adam's account will be affected by $300. So both these accounts are affected equally, that is by $300. All okay so far? Let's see what happened next. Oh, this month, Peter hired a new employee, Tom, for a temporary period to make sales in his grocery store, and he paid him $200 as salary. Now can you tell me the two accounts that will be affected? Yes. So in this specific case, cash and salary are the two accounts which gets affected equally, that is by $200. So this concept that every transaction has an equal effect on two different accounts or dual accounts is called the dual aspect concept in accounting. If we record only one side of the transaction, means if we make a single entry, there will be a mismatch. Like we saw, Peter's cash account did not show the correct amount. That is why we follow the dual aspect concept, also known as the double entry system of accounting. The double entry system of accounting gives an accurate and complete record. Peter will know the correct status of his business, expenses, incomes, assets, and liabilities. Since all of our accounts is based on this dual aspect concept, we need to be very careful while identifying the two accounts that are affected. We will understand and learn more about this concept when we will learn how to make and maintain the different books of accounts in our upcoming sessions. So, moving on, this month Peter is planning to launch his own homemade pickle brand in the market. He paid $5,000 for an advertisement campaign, but this advertisement campaign will take place in the next accounting period. So the service that we will receive or the revenue that we will receive because of this advertisement campaign will reflect in next year. So we will not record the expense when incurred in this case. It will be matched with the year we will receive the service or we can receive revenues related to it. This is nothing but the matching concern principle in accounting. This principle requires that you match revenues with the expenses incurred to earn those revenues and that you report them both at the same time period. Now you might be wondering, what is the use of having this concept? Just imagine if we wrongly record high expenditures or incomes all shown in one accounting period, we may have high profits in one year, again losses in the other, again high profits in the third year. This means if the wrong accounting treatment is given, it could result in undue profits or losses, which will create an imbalance in our accounting statement as it will not show a true and fair picture. Remember, we had talked about purchase of weighing machine that would benefit Peter's business for about 10 years. We said that we will distribute the cost or the expense for 10 years when the benefit is expected to be received. Even in that case, we are recording or matching the expense with the year in which we use the asset, or we can generate revenue from it. That example too is related to the matching principle. So to sum it all up, ideally the matching concept is based on a cause and effect relationship, and it requires a company to record or match expenses with related revenues in order to report a company's profitability during a specified time interval. So as an accountant, it is our duty that accounts are prepared on the basis of these generally accepted principles, as these principles would help in giving a true and fair picture of the business. So now Peter understands why it's important to give dual effects for each transaction, and he knows why certain expenses need to be recorded in the year as its related revenues. This was all for the month of September. Thank you. In our previous sessions, we've come across different concepts or principles of accounting. If you have missed those, do check them out by clicking on the links given on the screen. In this session, we will talk on 2 more accounting principles. Now, this is the 7th month of operation in my friend Peter's grocery business, October. Well, a few days ago, Peter was asking me some questions related to recording of transactions in accounting books. So today I've got 2 different kinds of sample reports to show. This one is a family doctor's clinic report, and the second one is the footwear store's report. In this first report prepared, we can see there are cash expenses and incomes. It looks like a very simple report. There are no debtors or creditors, and there are no pending expenses or any prepaid expenses recorded. These pending or prepaid expenses are normally seen with words like outstanding or advance, etc. So this means he has recorded only cash transactions, that is when money either comes into the business or when money goes out of the business. So this way of maintaining your records only when cash or money is received or paid is called the cash basis of accounting. Generally, the cash basis of accounting is used by small businesses who have fewer transactions, or by professionals whose nature of activities is best suited to cash basis of accounting. Its main advantage is that it is readily understood by people with little or no financial or accounting background. Thus, it is easier and also cost-effective method. But this system has certain drawbacks too. What happens if we place an order for a machinery and this machinery is received, but we are given a credit period of 30 days to pay for it? If we follow the cash system of accounting, since cash is not yet paid, we will not show this machinery as a fixed asset, and we will also not record payment to be made for it in future. So therefore, it gives an incorrect status of assets, and we don't know what is the owed amount. In today's world, majority of business transactions are on non-cash basis. This is a major drawback of keeping records on cash basis. Let me tell you another problem that could arise because of cash basis of accounting. So imagine there are two scenes here. Let's say we are talking about an electronics business. So there's a customer who purchases a television set for a specified price by giving a post-dated check, which will clear in about 15 days. And the television set will also be delivered within 15 to 20 days. Now, this was the last piece available for that model of television. The television set is packed and it is kept aside for delivery. So the sale has been made, but according to the cash basis of accounting, the sale will not be recorded as cash or money from the customer has not yet come in. Let's see the next scene. Now, after a few days, there is another customer in this store looking for that same television model. Now, that model has already been sold to the first customer physically, and it is already in the delivery stage. But due to no records kept on paper, it may still be showing as available. And the seller may make a mistake of selling that same product twice if goods sold on credit basis but not yet delivered is not recorded in books of accounts. This means cash basis of accounting is showing a wrong status of the stock available. So to avoid such conflicts and confusion, there is another way of keeping accounting records. Let's now take a look at the second report that we have here. Unlike the first report, in this report we can see there are debtors, there are creditors, and we also see the words like prepaid and outstanding. This means in this report, transactions are recorded even when expenses or purchases are pending to be paid, or incomes or money from sales are yet to be received. So all credit transactions are recorded. These transactions are not recorded when cash is coming in or going out, but they are recorded as and when it occurs. That is, when they arise or accrue. So this concept where we recognize transactions on arising or accruing is called the accrual basis of accounting, or the accrual concept. So if my friend Peter purchased goods on credit for $1,000 on 15th October and he has paid for it on 5th November, then according to this accrual concept, when should he record the purchase? Yes, it will be recorded on 15th October, that is, when this purchase was confirmed. The main difference between accrual and cash basis of accounting is the timing of when revenue and expenses are recognized in accounting books. To clarify the difference between the two, let's say Peter sold goods for $2,000 under the cash basis. That amount is not recorded in books until the customer hands over the money or until Peter receives the check. Under the accrual method, the $2,000 is recorded as revenue immediately when the sale is confirmed, even if you receive the money a few days or weeks later. The same thing applies for expenses. If you get an electric bill for $400, under the cash method, the amount is not added to books until you actually pay the bill. However, under the accrual method, the $400 is recorded as an expense in the period the expense relates to or when you utilize its services. So most businesses use this accrual system of accounting to get a true and fair picture of their business. However, some countries have laws which allow to keep their records on cash basis for certain types of businesses, specifically for professionals like CAs, doctors, lawyers, who do not deal in buying and selling of goods. Let's do a little exercise. Can you tell me which system of accounting is used in each of these cases? A business sold goods to Roy on 7th December on a credit period. The business recognizes this sale on 7th December itself. A dentist receives fees from patient $100 on giving services. The dentist accounts for his fees only when cash is received. An internet service provider receives advance of $400 this month for services that he will give in the next month. He recognizes the income in the next month when he will provide services for it. Well, that's all for today. Hope this clarifies Peter's doubts and has also helped you to understand this concept. Thank you. Hi, in this session we'll be learning one new accounting principle, and quickly we will cover up all the other principles that we have come across in our previous sessions. Well, there's one question in the minds of many new accountancy learners, just like my friend Peter's, and that is there a specified duration or dates according to which you must maintain your accounting reports? Now, a business is ongoing and continuous. It is not practical to wait forever to balance accounting books, meaning to collate or finalize these accounting statements. If we did that, we would not be able to calculate the current profit and loss and know the overall status of assets and liabilities at any particular point of time. Hence, we need to close books of accounts at some specific date or interval that could be yearly, quarterly, or even at monthly basis. When I say the word close, it means we do a cutoff of accounting transactions at a particular date. So we choose a defined beginning and an end of a period. Let's say Jan 1st to December 31st, or April 1st to March 31st, or June 1st to September 30th, and so on. So in this closing process, what is actually done is all the balances of each account during this period are posted to a statement called as the trial balance, and then adjustment entries are made, and finally these amounts are posted to the final statements of accounts, which then states the profit or loss of the business. This process helps us to arrive at results of our business activity during this particular period. Therefore, in order to report the periodical progress of a business, this concept of periodicity is developed, which assumes that indefinite life of a business is divided into parts, and each of these parts is called as an accounting period. An accounting period is generally of 12 months, but they are different in different countries and for different businesses. Most of the times, organizations choose to go with the statutory prescribed period in their country, which is also called as a fiscal period, because they need to consider that period for tax and statutory purposes. Statutory meaning legal. Many other businesses like to keep different accounting period due to business-specific reasons. The principle of accounting period helps a business in so many different ways, that is to analyze the performance of business, to compare their reports of any of their previous accounting periods. It helps a business to distribute their income at regular intervals, to calculate tax. It also helps banks and other financial institutions and creditors to know what is the position of this business, and so on. So this was the accounting period concept. I hope my friend Peter has the answer to his question now. So we have come to an end of all the 10 different principles in this session. I hope you're finding this easy to understand. The concepts will get more clear to you as and when we start recording and when we do the actual accounting. We'll be doing a little exercise now based on all the different accounting principles that we've covered so far. Let's begin. Feelings such as sorrow, anger, love, and happiness cannot be recorded in accounting books under this concept. Money measurement concept, which states only events that can be valued in terms of money can be recorded in accounting books. The basic idea of this concept is that business is separate from its owners. Which concept? The business entity concept. Next, under which concept income and expenses are recorded when they are due or they occur? That's right, accrual concept. This concept assumes that the business has a very long life. Which concept? The going concern concept. The concept which states every transaction should have two equal effects. The dual aspect concept. If the market price of a laptop is $800, but the owner bought it on a special sale for $500, at what price will he record the purchase according to the cost concept? $500, as the concept states that transactions should be recorded on cost price and not on the market price. Under the matching concept, the expenses is matched to the period of its related revenues or services. As per this concept, every transaction must be supported by a documentary evidence. Concept of objective evidence. According to this principle, the income is said to be realized when it is received or it is earned. The revenue recognition or the realization concept. And the last one, in order to report the periodical progress of a business, it is assumed that indefinite life of a business is divided into parts called as accounting period. So this is all for today. Thank you. In our previous sessions, we have learned some of the basic terminologies of accounts and learned all the accounting principles. Today, we will go through some very important practices that are essential to follow in order to gain loyalty and to portray a true picture of your business to stakeholders who are very important for the business. These practices are a custom or a way of doing things that is widely accepted and followed, and this is why they are termed as accounting conventions. My friend Peter has read about these conventions, but he wanted a clear picture of what each of them really meant. So let's try to understand each of these conventions. There are 4 conventions in total. The first one is materiality. The word material in legal terms means relevant and significant. Some financial information might be material or relevant to one company, but it might be irrelevant or immaterial to another. This is somewhat obvious when you think about a small company versus a large one. Let's assume there is a company with an annual profit of $1 million. If they misplace some goods from their office worth $2,000, this would be an immaterial thing for such $1 million company. It would not significantly affect the decisions of different users of the reports or stakeholders. Such losses can be ignored or clubbed together with other expenses in their accounting reports. However, if goods worth $2,000 is misplaced for a company whose annual profit is only $20,000, for them this is a material loss as it is 10% of their profit. Such information could sway the opinion of a financial statement user. Therefore, they would have to account for this loss separately and clearly show this on their reports so that the users can make proper judgment of the company's status. Another example, let's assume my friend Peter's income is approximately $50,000 annually. Okay, so if he spends $6,000 on his rent, it is a huge expense for him, right? But if he spends only $50 on stationery for the entire year, is this a material expense for his business? No. So he could club the expense under general expenses or miscellaneous expenses with other small expenses. The company generally decides what % of their income would they consider to be immaterial, and it is generally around 1%. This was the convention of materiality. Let's move on to the second convention, consistency. Suppose we go to a doctor and she prescribes us a medicine, say for a period of 10 days. We have to be consistent in taking the medication in order to see results and to be able to compare our health to that of the previous day. But if we keep changing our medication very often, or if we just skip them altogether, we will not be able to see the kind of results that were expected. The doctor will prescribe or allow us to take another medication only if there's a genuine reason like an allergy or a side effect. What is important here is being consistent. In the same way, in accountancy, we must maintain a uniform accounting practice. Otherwise, we would not be able to compare the progress of our company with our previous reports. Our reports may not show a true and fair picture of our profits or losses. If at all we are changing any method, the reason for it must be disclosed as a footnote so that users are aware of the changes that are affecting the amounts on these reports. Let's put it this way. To calculate valuation of stock or depreciation, there are many methods that we can use in accountancy. So if we choose one particular method in one accounting period, the same should be consistent in future accounting periods as well. Changes in method are permitted only when the new method follows gives a clear and better picture of the business activities. And also, its effect must be disclosed in the financial statements clearly. There are different rules in different countries regarding this permission of change in method or policies. Moving on to the third convention, conservatism. Do you remember a time when you expected low marks in an exam or expected something to go wrong? You would inform people of concern well in advance so that they do not have high expectations from you. But on the same hand, if you were very sure to get through an interview or score exceptionally well in an exam, you would not go around announcing it until the news was confirmed. The convention of conservatism is similar to this scenario. In a business, oftentimes there's a situation where in future you may or may not incur a particular loss. For example, let's say Peter has given some goods on credit to his neighbor for $500. But his neighbor has suffered huge losses and he needs to even vacate his house. Peter is well aware of his financial condition, and so he kind of suspects that the money the neighbor owes him of $500 might not be returned in future. This is called as a doubtful debt. Such kind of losses may or may not arise in future. However, Peter will have to provide for such losses in advance to play a safe game and to be prepared for these kinds of losses if they happen to arise in future. On the other hand, expected incomes or profits are never shown on reports until they arise, until they are confirmed. The business does not want to keep its stakeholders in high hopes and then let them make wrong decisions if at all these incomes or profits do not arise. It'll be like cheating them by wrongly reporting things on their reports that have not happened. So, conservatism should be applied cautiously or prudently. such that the statements do not get distorted. In a way, conservatism calls for the accountant to present the worst-case scenario in the financial statements. This was the convention of conservatism. All okay so far? Let's proceed to the last convention, that is convention of full disclosure. The convention of full disclosure states that you should correctly and clearly disclose all important matters in financial statement reports that would affect a reader's understanding of those statements. You might be wondering what kind of disclosures. Now, actually, this convention is where all the other conventions that we just studied come into the picture. We should disclose if there is any change in the method or policy that we use for calculating or valuation purpose, which might sway the opinion of the user. We learn this in consistency. We should also disclose all relevant material information, convention of materiality. We should disclose all expected, probable, or possible losses and provide for them well in advance. This is the convention of conservatism. It may also include a case filed in the court or a dispute with government entity over a tax position, any important non-monetary transaction, a relation with a company with whom there is a significant transaction volume, anything which cannot be included in the accounting reports but are of great value to the users of these reports. And where is this disclosure made? There is a separate section called as Notes to Accounts or Disclosures below the financial statements in accounting reports, where all these discussed important details are disclosed. This is convention of disclosure. With this, we come to an end of all the accounting conventions and principles. My friend Peter is now well aware of what each of them means. Thank you.
Hey guys! We have seen the principles and conventions of accounting, right? Let's revise it quickly. Remember, if your basics are strong, then no need to worry at all. Today, we are going to test your knowledge on these principles and conventions. So, let's see who will become an accounting expert. So, challenge yourself. Be quick in the first round. So, here we go. Well done. Now let's move on to the next stage. Think and answer. You may take a pause whenever you want. Miss Lucifer uses her company's credit card for personal expenses and recorded in the business books. So what do you think? Which accounting principle is Miss Lucifer violating? A company having a net income of 1 lakh suffered a loss of 100 due to fire. Which concept states that the loss would not affect the overall financial picture of the company? Alex and Company Insurance Building. Insurance company bills 600 every 6 months, one in January, the next in July. Which concept is followed if 600 is paid in month of Jan and recorded immediately? Should I give you the hint? Let's choose 50-50 option. Now it will be easier. Jackie purchases online grocery worth 2,000. He made the payment with the help of debit card. On making the payment, which concept allows the seller to record the transaction as sales? As per this concept, assets are categorized into fixed and current. Should we take help of our friend? So here is our friend. Let's see what he has answered. Would you like to go with your friend's answer or would you like to change it? Let's go with your friend's answer. Yes, we got it correct. Here is the last one for you. As per which principle a company is required to report the paid amount of a land in its balance sheet rather than its current market value? Well done. Hope you have enjoyed this ride. Hello friends. Today we are just sitting in our office and we saw a newspaper named Let's Tude. It was having news like they are going to introduce selfie center in which they will be introducing new way of learning and other news. The next page was the fun time. On that there are some crossword puzzles relating to accounting. So we just thought that we should try it. These all questions are related to principles and conventions. So first of all, let's revise it quickly. Let's solve it together. We can start solving from anywhere or any point. I'm just going in the order of numbers. So let's begin. The first one is across. Company A disclosed a lawsuit in their financial statement. The suit has not been settled yet. Guess the principal. There is hint also in the question itself. Yes, the disclosure concept. Then there is second down. Mr. Ricky has made sale of 20,000 and he knows 5,000 is going to be bad debts. So for that, he already made a provision. So which accounting convention will be applicable here? The words start from C. Correct, conservatism convention. Then we have again down third. The personal assets of the owner will not appear on the company's balance sheet because of which principle? Think faster. Yes, the entity principle. Then we have fourth one, which is across. A transaction should be recorded in the period in which they actually occur rather than when the cash is received. Which principle states this? So think about the principle. Accrual principle. Then we have fifth one, which is down. Changing accounting principles every year would violate the first three words are CON. Now you can guess the other letters. Yes, the consistency convention. It says that every business should be consistent. Then we have sixth one, which is across. Which concept requires a company's balance sheet to report its land at the cost price rather than its market price? It's very easy. Yes, the cost principle. Then again across. Insignificant details need not be disclosed. Which accounting convention justifies this? Yes, the materiality convention. Then we have across again eighth one. Total assets is equal to capital plus outsider's liability. Which concept applies to this equation? The word starts from D. Let's move to the next one. Company will continue on long enough to carry out its objectives and commitments. Which principle is associated with this assumption? Think and answer. Yes, the going concern principle. And here we have the last one. Profit is ascertained by comparing revenue of the business with its cost. Guess the principle. Correct, it's the matching principle. So with that, here we have completed the crossword. If you guys want to practice, there is one more crossword you can try on your own. And don't forget to read newspapers. Thank you.
In our previous sessions, we have seen what are the basic terms and concepts, principles of accounting. Now, we all know my friend Peter. His grocery store business is really doing well, and on a daily basis, he has to deal with many transactions. So, he wanted to know what are some important things in accountancy which will help him to keep his records in a more organized format and also help him to save time as well as get accurate reports. So in this session, we are going to talk about a very important topic of accounting that will help a business to have organized, classified, and accurate reports. That is, classification of accounts. Well, at some point, we all must have had this problem of not being able to find the right outfit on time because of having a very messy and clumsy wardrobe, right? Let's say we were finding our favorite black shirt, and we might have even gotten late for work or school because of that. How can this problem be fixed? What if we organized our wardrobe as different drawers or compartments and labeled each one of them neatly? Now is it easier to find that black shirt we were looking for? Of course. Let's try to connect the same scenario to accounting. Suppose we record different transactions aimlessly, anywhere in our books. Can we locate all bank-related transactions easily and answer what will be the bank balance? No. Everything here is jumbled up and we would not be able to find what is the right balance and the right details of any particular account. Therefore, we group all transactions belonging to one category in one account. So if all bank-related transactions are recorded separately under a separate bank account, then we can easily locate all bank transactions and find what is the correct bank balance. Similarly, we will maintain a separate cash account which will give details about how much cash we received, how much cash we have paid, and how much we will have at the end of one accounting period. In the same way, we'll have a separate capital account, a separate account for Mr. X, salary account, and well, in accountancy, we generally denote the word account by AC. So from what we have seen, we can summarize or conclude that an account is a systematic and summarized record of similar kind of transactions pertaining to one particular person, property, or any expense and incomes. Having understood this first step, let's move on to a very important and very basic accounting concept, which is classification of accounts. Just like we maintain different drawers in a wardrobe and classify them into different heads, in the same way, in accountancy, we will classify different accounts into two types, namely personal and impersonal account. But why do we need to classify them? Because well-classified accounts will help us to make the correct entries and to prepare sound financial statements, that is the profit and loss and the balance sheet. So coming to the first category, that is personal account. Personal. The word relates to a person. So we would have David's account, Philip's account, Jack's account. Accounts having names of people or natural persons. But personal accounts in accounting also includes artificial or legal persons as well. When we say artificial person, in any company or organization, the decisions are made in the name of the company and not any particular person. But the law gives the company certain privileges or rights to be considered as a person. They have a separate legal identity, and therefore all organizations come under personal account. So artificial persons include public limited companies, private limited companies, firms, cooperative societies, etc. For example, ABC Private Limited or Blossom Cooperative Housing Society. There are also certain accounts like, say, the capital account, which represents money brought in by the owner. Owner is a personal account. So capital account is actually representing a person. These kind of accounts are also called as personal accounts, and we call them the representative personal account. Similarly, there is debtors account, which represents all different persons owing money to the business. So again, debtor is a representative personal account. Let's move on to the second category, that is impersonal account. Anything which does not fall into the personal account is an impersonal account. It is further classified into two categories, that is real account and nominal account. Real account relates to the company's properties and assets which are owned by the business concern, like furniture, land, buildings, etc. Now, assets like furniture and machinery and building are tangible in nature. They have a physical existence and they can be seen and touched. But we all must have come across terms like copyrights, trademarks, patent rights, goodwill of a company. All of these can be owned by a business and they have money value, even though they are not physical in nature. These are intangible assets of a business, and these can be found on documents. So the real accounts includes all tangible as well as intangible assets. Next is the nominal account. These accounts relate to all income and expenses, profits and losses. Let's say we pay salaries, or we pay rent, or we pay training fees. Actually, what we are doing here is we are paying money, but they are all given specific names depending upon the reason of payment. Are you getting me? We are paying money for rent or money for salaries. Such accounts like the salary expense account or the rent expense account, interest expense account, or also incomes like commission received account, interest received account, discount received account. All of these accounts exist only in name, meaning they are nominal. Hence, they are termed as nominal accounts. So from all that we have seen, that is personal, real, and nominal accounts, what we can conclude is that the items that appear on the profit and loss account or the income and expenses statement consist of all nominal accounts, whereas the balance sheet, which state our assets and liabilities, consist of all personal and real accounts. Peter says he can relate this information to what he is doing, and he can understand his accounts a little better now and keep them organized. Let's have a quick recap of what we have learned in this session. Let's check our understanding by doing a little exercise. Classify these accounts into personal, real, or nominal. Joy's account, cash account, capital account, interest paid account, interest received account, salary account, bank account, machinery account, ABC Private Limited account, goodwill account. So that's all for today's session. Thank you.
Hello friends, in our previous session we have seen how all the accounts are classified into real, personal and nominal accounts. We also have an idea about the dual aspect concept or the double entry system of accounting, which states that every transaction has two equal effects. Without recording both the effects or dual effects in books of accounts, our record will be incomplete or imbalanced and it will show a wrong status. Now let's go one step further and talk about what are these two equal effects. One of these two effects is always a debit and other effect is always a credit. So what are these terms debit and credit? They are just formal bookkeeping and accounting terms that have opposite meanings. These are like the pillars of accounting on which the entire accounting is based. Now let's proceed further. A few days ago, I was at my friend Peter's grocery store and was checking to see how easy keeping his records. So here we have picked 5 random transactions from Peter's book and we are going to analyze each one of them. So the first transaction is, now this is a sales transaction. To analyze this, the important thing to do is to find out which are the two accounts that will be affected as per the dual aspect concept. Here, goods have been sold, so the sales account will be affected, and second would be Mr. Adams' account, as the goods are sold on credit. Now next step is classify these accounts into real, personal and nominal. As we have discussed in our previous session, all the incomes comes under the nominal account. Therefore, sales is a nominal account and the accounts which relate to the person comes under the personal account. So, Adam's account is a personal account. Now, the question is, which account should we debit and which should we credit? So, whenever a person receives a benefit in the form of goods or cash, the account of the person is debited by the amount of the benefit received. So Mr. Adams' account is debited since he is a receiver of the goods. That is, he is a debtor. The person who is in debt, that is the debtor, is debited. So the second account affected, sales account, which is a nominal account. It's like a revenue. Now, all revenues, incomes and gains increases the profit of the business and so we credit them. Like we have seen that every debit has an equal and corresponding credit effect, here we have one debit and one credit effect. So the correct entry is Mr. Adams' account debit and sales account credit. So now onwards we will check every transaction by following these 3 steps. Now let's look at the second transaction. Now this is a purchase transaction and this is Peter's entry. Let's analyze it. Now the first is the accounts affected. So here one is Mr. Alfred account and the second is purchase account. Now here purchase comes under the nominal accounts and Mr. Alfred is a personal account. Now we will come to the third step, debit and credit. When a person gives the benefit of goods or cash, that is the creditor, his account is credited by the amount of the benefit given. So Mr. Alfred's account will be credited. So here person who gives the credit, that is the creditor, is credited. Now the second account is a purchase account, which is a nominal account, is an expense. Now all the expenses and losses decreases the profit of the business and hence they are debited. Here one trick is the word debtor and creditor itself is giving the answer. Debtor, debit, creditor, credit. Now let's move on to the next transaction. Here, note that only those purchase or sales transactions where it specifically mentioned that payment was in cash is considered to be a cash transaction. If cash is not mentioned, it is assumed to be a credit transaction, and so the debit or credit effect will be given to the party's name mentioned. Let's see what Peter has done. So here, do you think Roy's account should be affected? No, because this transaction is a cash transaction. So no party will be affected. So in this case, furniture and cash are the two accounts affected. And as we know, assets will come under the real accounts. So furniture and cash both will come under the real account. Okay? Now, whenever an asset comes into the business through its purchase or receipt, asset account is debited. So here we have purchased furniture, so furniture will be debited. Conversely, whenever asset goes out of the business through its sales or payment, asset account is credited. And here we have paid cash, so it will get credited. Now let's see next transaction. Now here the two accounts which are affected are salary account and cash account. Now salary is a nominal account as it's an expense of the business, so it will have debit effect, right? And second is a cash, as it comes under the real account, it's an asset of the business. Asset going out of the business, so it will be credited. So the second part is correct. All okay so far? The last one. Now here Peter debited commission account. Let's analyze this transaction. First step, which are the two accounts? One is commission and second is cash account. Second, classification. Commission will come under the nominal account as it's an income of the business, and cash will come under the real account as it's an asset. So here we will debit cash account as we have received the cash, and we will credit commission account as it is the income of the business. With this, we have finished checking Peter's book and rectified it. We have also understood what is debit and credit, and we have learned logical understanding of debit and credit effect. Now here are some rules of each type of account. So if we notice, in first example we have debited the person who is receiving the benefit, and in second example we have credited the person who is giving the benefit. So when any transaction includes persons, then the rule of personal account is debit the receiver, credit the giver. And in third example, we have debited the asset which is coming into the business, and we have credited the asset which is going out of the business. So when any transaction includes assets, then the rule of real account is debit what comes in, credit what goes out. And in fourth and fifth example, we have debited the expenses and we have credited incomes. So when any transaction is of expense, incomes, losses and gains, then the rule of nominal account is debit all expenses and losses, credit all incomes and gains. So hope you guys have understood this concept. Thank you.
In today's session, we are going to come across an interesting concept, that is accounting equation, which is the cornerstone and foundation of our accounting process. It will give us a deeper understanding of debit and credit and will help us in accounting and analyzing the financial reports. Let us try to understand the accounting equation from this sample balance sheet. As we know that the balance sheet is a statement of the financial position of a business on a particular date. We will quickly go through some elements of the balance sheet. Balance sheet has two sides, that is assets and liabilities. Assets are the things that the business owns like machinery, furniture, cash, stock, etc. It can also include intangible assets like goodwill, patents, etc. And liabilities is what the business owes to other parties like loans, creditors, outstanding expenses, as well what the business owes to the owner. That is the amount introduced by the owner in the business, which is termed as capital. So moving on, here we are taking some random transactions to understand the purpose and to see how any transaction affects the balance sheet. Suppose Peter purchases a machinery for his grocery shop and pays cash 10,000. Here, as machinery is purchased, so our asset will increase by 10,000, and on the other hand, as we are paying out cash, another asset will decrease by 10,000. Here we can see that one asset increases in exchange for the other asset and decreases with an equal amount. So the final balances are equal. Let's take another situation now. Suppose if goods are purchased worth 30,000 on credit, then the stock of goods, that is asset, will increase as we have purchased goods of 30,000. But also we have an obligation to make payment to the creditor, which is a liability. As we have learned in double entry system that there are two equal effects of each transaction. So the same thing happens here. So the goods or the stock, which is our asset, is increasing, and on the other side, creditors, which is our liability, will also increase with an equal amount. So it would affect both the sides of balance sheet with an equal amount. So now let us take few more sample transactions and see whether the total balances stay equal. Suppose Peter withdraws 2,500 cash for his medical expenses. As medical expenses are not related to his business, we call withdrawals for any personal use as drawings. Since owner already withdrew, the business now owes less amount to the owner. So liability will decrease, and as cash is withdrawn from business, cash will also decrease from the asset. We can notice that the liabilities and assets decreases equally. Are you all with me? Let's take one last example to see if the balances are equal for other transactions as well. Suppose a loan of 20,000 is taken from the bank to pay off the creditors. So here we have borrowed loan from bank, so one liability is increased, and as we are paying off creditors, so another liability is decreased. So one liability increases and other liability decreases equally, nullifying the effect and making the balances equal again. So from these different examples, we can conclude that the effect of any transaction will either nullify the balances or they will affect both the sides equally. Hence, we can say that assets is equal to liabilities, and liability includes liability towards the owner as well as external liabilities. So, assets is equal to capital plus external liabilities, and this is what is known as the accounting equation. If we look at a balance sheet, we can notice that the balance sheet is basically an extended form or a reflection of the accounting equation. Accounting equation is also known as the balance sheet equation. If there is any change in value of any side of the equation, there must be a corresponding change on the other side of the equation. With this, we have a better understanding of the accounting equation. Let us do a simple exercise using the accounting equation that we have just learned. Peter has total assets of 10 lakh and capital of 4 lakh. Calculate liabilities. Using the accounting equation, let's substitute all the values. So we get liabilities equal to 6 lakh. So here we end with our accounting equation. Hope it was easy to understand. We will make accounting easy and simple for you. Thank you.